Right, so we've covered in other videos how exchange-traded and over-the-counter markets work, and in this video I'm going to explain the role and names of different market participants in an over-the-counter or OTC market. So I'll continue where we left it off in the previous video, where we talked about the global interbank network, where there are 15, 20 banks and non-banks who all know each other, who all have credit relationships with each other, who publish their prices for all the transactions that they do with each other and with the third parties, and they issue prices via an ECN or various ECNs, electronic communication networks, who are basically connected to either this subsection or that subsection or whatever. There could be different price feeds going on that stream prices to the outside world. What is the outside world? But by definition is parties who are not part, they're basically the have-nots. These are the have trust, and then outside of that is the have-nots. There are people who don't have either a large enough balance sheet or a large enough credibility or credit line with these guys to trade with them directly and need a credit intermediary. So, who would be a credit intermediary? Well, say I'm a small retail trader or a small retail broker, and I want to get access to the best price for these 15 guys. Well, somebody will have to. So, one way for me to get the best price would be to, if I could, which I can't, if I could trade against, get the information of the best price from this guy and from that price, I could aggregate both price feeds and say, if I'm going to open a euro-dollar trade, my long order would end up with this guy because he's actually cheaper. Yeah. But when I unwind the position and I would do the short order, maybe that guy is offering a better price. So I'm actually flat, but I've got a long position with one guy and a short position with the other guy, so I'm still paying swaps on the thing. It's cost of maintaining those positions, right? So, of course, with two guys, you could conceivably say, well, I'm going to open brokerage accounts with each of these two, but when you've got 15, very quickly, the benefits of the improved spread that you get are far outweighed by the cost of posting out collateral and paying swaps on each of those positions. So this is where the role of a prime broker comes in. So a prime broker could be somebody like, say Saxo or potentially LMAX in our case, who has collateral posted out with some or all of these parties, and then leases that collateral out to the Darwinex. Okay, so in this case, we would have a prime broker who's the liquidity, the credit provider that's extending cash so that we don't have to open brokerage accounts with each and every one of the 15, 20, 25 market participants. And then each of the market participants would be liquidity providers to us in a way such that we get an aggregate feed offering the best price at all times from this version of the electronic communications network that we have created.
So the prime broker technically sits outside the circle or inside the circle?
So the prime broker doesn't sit inside this circle, but they've put up cash with the circle, so they will have basically paid their way into the circle. So they would have actually, to be honest with you, correct. So they sit out here.
So Saxo would be outside.
Saxo would be outside this thing because they're a young entity. They're not part of the club. They have posted a ton of cash.
Just for the benefit of the audience.
Yeah. So Saxo have posted a ton of cash out with all these guys, and the way they make money on that cash is by generating volume through us, volume which we otherwise wouldn't be able to do. So it's basically it's a club that's closed for both Saxo and the retail aggregator like us and the end customer. But because they have the muscle to post out cash with all of them, provided they have enough people like us trading at all times, then the rotation of their cash is fast enough that they overcome the cost of opportunity of having it parked down there. So that's why this is a volume business. The more it rotates, the better return on the capital they get, and of course the better terms they can offer, and therefore the more people flocked to this opportunity. Eventually, if they grow large enough, well, they could actually enter the club and potentially start offering liquidity. Because remember, Saxo has a prime business, like a prime brokerage business that gives access to these guys, but they also have their own retail business and white label business. So they have the benefit of crossing off flow between these parties where they haven't had to post any cash with the outside world, and that's free money.
Yes.
Right? So in a way, basically what happens is Saxo had to build these credit relationships to offload risk on their retail business. And then at some point they said, hey, we've got a ton of cash parked in here, might as well use it some more. So they really opened up the business to third parties, which made better use of their cash, got them better conditions, which of course attracted more retail traders and more wholesale aggregators. And that's how the thing works. But importantly, so a prime broker would be somebody who extends credit to tap into the interbank liquidity providers. And then meanwhile, if they have another business, which is basically a retail business, they can internalize flow, match flow without taking risk to offer everybody better terms because they've created liquidity.
This is in fact a really good way to project what the market really is. It's not an abstract concept. It is a very...
Yeah, and it's actually good to know what one's talking about, because you say, the market this, the market that. But if you don't have a fucking clue, just watch this video.